G'day Andrew, how are you today, mate?
Yeah, morning Shane. Very well, thank you.
Well, here we are in September and we've got lots to talk about today. And as is always the case, it seems as though 1 month rolls around and there's a whole lot of news. Another month passes and there's more news again.
Yeah, correct.
So today we sort of want to jump under the hood a little bit of, probably a continued theme of what's been discussed in these forums the last several months really. Sort of focusing around, are we seeing economic slowdown or, globally, are we seeing the economies of the world slowing down? Interest rate policy, it's obviously topical, and we're seeing movements around that side of things. And of course, a session or a discussion of this nature wouldn't be the same without reference to Donald Trump in some way, shape, or form. And he's got himself into another situation with tariffs. So perhaps we should start with the economy. I guess what are we seeing a little bit, Andrew, from your perspective? I mean, are we seeing economy slow, or how do you read it at this point in time?
Yeah, look, there's certainly various data points that are suggesting or leading towards a gradual slowdown, and certainly in the data pack in the report that we'll send out, there's some GDP numbers and charts that reference that. So against historical lows. But what's been happening is the economies are still being quite resilient. So I know US unemployment and Australian unemployment has ticked up slightly based on recent reads, but it's still still well below long-term and historical trends. So
it's interesting, isn't it? Like you sort of read these headlines and I feel as though the media of the world is really good at selling the bad news that's out there. And
that's right.
And if you kind of really consider this economic slowdown, if you will, in context of the last 3 or 4 years, it's happened by design, right? I mean, we've had restrictive interest rate environment. Post-COVID, we saw inflation rise heavily. Then rates have had to rise on the back of that to curtail inflation. And the very outcome of a sort of restrictive interest rate environment is slowing down economy.
That's the planned outcome, isn't it? And we've seen it. And I think the RBA in particular, they do cop a bit of flack, but I think they've done a reasonable sort of job balancing out the state and health of the economy with targeting they had a clear directive to get inflation down to that 2 to 3% level, and that's what's played out.
Seems like they've probably against the backdrop of pressure to act a bit faster or differently to how they seem to have managed it so far, touch wood, reasonably well. And I think the other interesting part about it from my observation is that statistically it takes about 18 months for an interest rate cut or rise to have full effect in the economy. So if, some of the questions I've been asked of late is that we've had now 3 rate cuts this calendar year, and people asking, how come they're not being felt more, seen or sort of observed more so far in the economy today? And I feel as though the response is always that we're still feeling a little bit of lag of the interest rate rising cycle and the restrictive environment that we had, particularly through 2024. And these cuts that we've had this year will probably start to feel the benefit of that in 2026. Yeah,
and I think combined with the prolonged higher inflation and the cost of living that households have been experiencing, so they're probably just biding their time just to ride it out and see get ahead of the game, and then we might start to see a pick up in activity, and also I think from a business investment point of view as well, we might that might ramp up as well with further cuts.
Agreed. We have a slide in the deck that talks about consumer confidence, and it overlays a little bit to what you're talking about, their business outlook, and it's seeing a sort of a steady spike up. Not to previous highs of feeling great about the world, but certainly a bit of a spike up. And I suppose we think about interest rates more broadly. I don't know. It seems like it's discussed way too often for my liking in the press, but. I think the outlook probably still speaks a little bit to more stimulus needed in the next little while. And I think to your point earlier about the Reserve Bank being measured with respect to their response means that we've got to this point now where they haven't, whipped around too much, and we have the prospect of cutting again if necessary. And then, of course, globally, they can do the same thing, and that will help. That inflationary impact you talked about before. I feel like that's a really good shout out because. one of the misconceptions with inflation is that inflation has come back down to the target range, but it doesn't necessarily mean that the cost of goods go back to what they were before inflation was an issue. It's like an inflationary spike, and then it flattens, and then it, but doesn't actually reverse. The cost of a loaf of bread or a cup of coffee is probably indicative of that. Inflation's under control, but the cost of coffee is still the same as what it was when inflation was high, or still trending up, in fact.
Well, we've all experienced the basket of goods, or the visit to the supermarket, or whatever you do, trip to the petrol station, and we're seeing each time that has felt like it's more and more expensive compared to 12 months ago, 2 years ago, 3 years ago. So it absolutely has had an impact.
Agreed. And look, I think in the other part too, on the backdrop of all this, is that the share markets of the world, in contrast to the economy, have still been very strong.
They have.
And, I think, as I sort of alluded to in the outset, that Trump is still that X factor globally. And, a discussion point for today is around, has he illegally put tariffs in place? I don't know. Have you got a sense of what do you think about that? I mean, your guess is as good as mine, I suspect.
Yeah, I mean, he's clearly very unpredictable in what he does. Clearly, he's got an agenda, and some recent commentary. We'll talk about this earlier. Shane was around. I'm sure if he'll find a way if the ruling goes against him. So if if the appeal is unsuccessful and the court ruling applies that many of the tariffs are illegal, then he'll find a way around that, I'm sure.
Yeah, he seems like he all of his policy making is just bull at a gate type approach, and I'll do what I want. And I think really, observationally, the fear back in April, obviously we saw equity markets fall quite heavily in that month on the basis that tariffs have been introduced and you're going to be high and cause issues globally. They're settled now, right? We've sort of landed this 10 to 15% tariff level. And I can't help but feel that, you're seeing the bond markets in the US, the sort of particularly long-dated bonds, trend up at times. And the US is experiencing inflation at the moment like they probably haven't experienced since COVID, or maybe even before. So, I'm pleased I'm not living in the US right at this point in time from cost of living pressure.
Yeah, more pronounced over there relative to here.
Yeah. And I think if you're kind of, thinking about all this, and again, the headlines always catch your eye, but as we always talk about each month, really it's how do we as investors navigate our way through what is a forever changing landscape in investment markets. And I don't know how you feel, Andrew, but at times I feel a bit like a broken record in sort of talking about, sort of sticking in our lane and the investor psychology behind, trying to dismiss some of the short-term noise in favour of a medium to longer term view. Yeah,
well, look, it's very easy to get caught up in the wave of what's happening now, and there's always something in the news, good and bad, about certain global events or economic events that play out and impact the share markets, and we see that through history. You go back 100 years, and there's data points that reflect certain changes or key world events that have impacted the markets. But importantly, to your points about sticking to the strategy, staying in your lane, being clear around the purpose of what we're trying to set out and what clients are set out to do, and just participate in the ups and downs. Don't try and time the market. Don't try and get too cute, because by doing that, you then run the risk of value destroying, or certainly not or getting suboptimal outcomes.
Agree, and I think that's certainly what we observe at times, and I feel very lucky with the people we work with in that most people are very measured about their investment decisions, but there is a tendency at times when you see the markets high or low that we emotionally react to the situation and want to change our risk profile or our tolerance for risk. And it's common right now, for example, to hear people say maybe I should just tilt up my equity exposure or my risk exposure because returns have been quite healthy. And I think it's always a healthy reminder to think about your mindset at a point in time when the markets weren't so favourable, and kind of try and base your decision about risk as to how you felt when it wasn't, even as recently as April. How you felt at that point in time. It's investor psychology. I think, Andrew, is probably the most fun that I think we always have and observe with investors.
Well, there's on the upside, there's a fear of missing out, isn't there? And conversely, on the downside, there's a fear of if I don't jump out, what's end position going to be. But that's why we forever, again, we sound like a broken record, but it's just stay the course. It's okay. However, having said that, there's opportunities in both cycles to perhaps get ahead of the game, and when markets are at a high and you've had your portfolios have experienced and had some pretty strong performance, and you've got plans in place, well, that might be a good opportunity to reposition your portfolio and provision some cash for goal-based or purpose-based needs, whether it's a big trip or helping out kids and those sort of things. So those activities.
Good shout out, isn't it? I mean, it's a perfect chance to pragmatically look at your situation, say, okay, if we need some capital, let's just park it, for the time being, and take that return that's been healthy, because we simply don't know what happens, in the 12 months ahead. And of course, we provision for a rainy day and hope it doesn't rain. But I think it's a really, really healthy shout out to take some earnings if you can, and put some funds to the side to have some good times in the years ahead, right? But the last thing I also wanted to flag, Andrew, anything else from your end, but it's really just, again, as we always talk about, the discipline and consistency of having a good investment structure, the long-term impact of returns, and the chart that we share on the screen that you'll see talks about that cycle that we talk every single month about, the long-term nature of markets, and also, I guess, the relativity of this little run in the markets relative to other, I wouldn't say necessarily say we're in a bull market, but, looking at the run on the market, it feels a bit, it's been very strong. So just, always keep in mind that cycles of years gone by and how they correlate today, as the chart on the screen shows.
Yeah, that's right. And both in time, so it's been basically since COVID, that run, that on that chart will show. I think it's been about 5 years, so it's a bit below the average of that 50-year view that we look at for the bull versus the bear market chart. So it's you sort of see that as a guide.
Indeed. Well, thank you, Andrew, and thank you everyone for listening. And we look forward to, dare I say, October. We're getting very close to Christmas, and let's hope September's kind to us again, and we'll see everyone online again next month.
Well, football finals first, and you and I will be both quite passive because
we won't be watching.
Our teams are not participating.
Thanks for reminding me, Andrew, by the way, that's happening. But anyway, we'll see you next month.
Thanks, everyone.